Welcome to this explainer. Today, we're diving into a massive anonymous expert report that is basically a masterclass on how to strategically survive and, more importantly, thrive within our hyper-complex economic and legal systems. We're skipping the generic, surface-level advice today. Instead, we're going to act as an analytical engine. We want to identify the core mechanisms, those hidden cause and effect relationships, and the totally non-obvious details that really separate the people who just participate in the system from the people who actually master it.
All right, so here's our roadmap for today. We're going to hit strategic career market alignment, navigating real estate investments, essential tax compliance rules, maximizing upcoming tax benefits, and finally, intellectual property and security. Let's get right to it.
Starting right off with phase one, strategic career market alignment.
So have you ever wondered why identical candidate profiles yield vastly different career outcomes? Experts point out a really fascinating hidden reality here. You can literally have thousands of applicants with the exact same credentials, yet only a tiny fraction actually secure interviews. The mechanism of failure here isn't a lack of intelligence or skill, it's a lack of alignment. Your profile absolutely must map precisely to the underlying demands of your specific regional market.
That spray and pray method of mass applying, it's just an expensive gamble of your time and energy. Instead, top performers analyze regional market saturation. They take their specialized skills and map them directly to specific institutional goals, prioritizing deeply researched, high-impact networking over sheer volume is the non-obvious lever that takes you from being just another generic applicant to an undeniable must-hire asset. Moving right along to phase two, navigating real estate investments.
Okay, to avoid falling into the dreaded house poor trap, your total housing costs absolutely must be strictly limited to a conservative 20 to 25% of your income. Now, I know general rules out there often suggest pushing that up to 30%, but experts strongly argue against that. For demographics tied to strict employment timelines, maximizing your housing budget completely removes your ability to make strategic career pivots if a sudden job loss happens. You lose your leverage. So you really need a rigid checklist before you even think about locking your capital into a property. Real estate is not easily liquidated. You've got to secure a 1-year emergency cash runway and a solid 6 to 10-year geographic commitment. And hey, if you are transitioning out of a property, you absolutely must understand the exact mechanisms for reporting the sale of a rental property. That includes calculating tricky things like depreciation recapture and filing the correct capital gains forms, because if you don't account for those hidden systemic costs, they will eat your profits alive. Breaking that geographic commitment early causes severe wealth destruction. It's brutal. If you are forced to sell a home within just a few years of buying it, you aren't just breaking even, you are actively bleeding capital. When you factor in realtor fees, closing costs, market fluctuations, and repair costs, short-term sales lead to a massive capital loss. Honestly, in the short term, renting is simply paying a premium for flexibility.
Let's pivot now to phase three, essential tax compliance rules.
Understanding the compliance lifecycle is an absolute game changer. It's way more than just the standard April 15th deadline and that 6-month extension. Experts highlight that common, incredibly expensive withholding errors on Form W-4 have to be corrected early in the year to prevent massive underpayment penalties later. Plus, you have a definitive 3-year window to amend your returns. This is crucial for claiming forgotten educational credits, like those on the Form 1098-T tuition statement, before those funds are just legally forfeited to the government forever. Look at this contrast. It reveals a really harsh systemic rule. Ignoring communication with tax authorities is penalized literally 10 times more harshly than just lacking the funds to pay them immediately. The system prioritizes data over immediate payment. So, what's the actionable insight here? Never, ever let the fear of an unpaid balance stop you from actually filing your return on time. Now, if you do make a mistake on a past W-4 or a 1098-T, there is a strict 3-step methodology. It's the exact mechanical process required to correct it. You put the original data in column 1, the exact mathematical difference in column 2, and the corrected reality in column 3. It's purely a structured data correction. There is absolutely no room for narrative explanation. The math just has to speak for itself.
Which brings us to the really fun stuff in Phase 4, maximizing upcoming tax benefits. $10,000. Yes, you heard that right. This represents a massive, newly available deduction for interest paid on domestic auto loans, which functions as a powerful lever to lower your overall tax burden. But here's the non-obvious detail. Targeted deductions like this require meticulous record keeping to prove your eligibility. That means your daily organizational habits directly dictate the size of your financial returns.
And beyond vehicles, if you are looking at ways to maximize your tax refund in 2026, experts point out several new legislative incentives. We're talking about the complete deduction of qualified overtime pay and service industry tips, a $6,000 bonus deduction for qualifying seniors, expanded dependent care credits, and newly created tax advantage savings accounts for minors. The tax code actively rewards people who proactively align their behavior with these brand new incentives. Finally, let's wrap up with Phase 5, intellectual property and security. There's this massive and frankly dangerous misconception that trademarks and copyrights do the exact same thing. They don't. Trademarks protect brand identifiers, like your name and your logo, specifically to prevent consumer confusion in the marketplace. Copyrights, on the other hand, protect original creative works, like media or software code, strictly to prevent unauthorized duplication. Understanding this mechanism dictates which federal office you even apply to and which asset is actually being shielded. This reveals the hidden complexity of asset protection. Experts actually call this the logo trap. See, a logo isn't just one thing. The creative drawing of it requires a copyright to prevent someone from literally copying and pasting the image. But its functional use out in the real world, identifying your specific business, requires a trademark to prevent competitors from using a similar vibe or confusing your customers. True asset protection is all about applying multiple, redundant layers of legal defense. So here's the big question we want to leave you with. Have you audited your professional and financial foundations to ensure you're actually building wealth rather than just surviving the system? Today, we've broken down the deep cause and effect relationships governing careers, real estate, taxation, and intellectual property. The system fundamentally rewards structured preparation and severely penalizes emotional, rushed decisions. Take this analytical framework, apply it to your own life, and start optimizing your strategy today. Thank you so much for joining me for this explainer.